DSCR loan rates and conventional mortgage rates both dropped 7 basis points this week, with the 30-year fixed easing from 6.45% down to 6.38%. A ceasefire between the US and Iran crashed oil prices by nearly 15%. Inflation data came in hot on the headline, but cool where it actually counts. And somehow, all of it nudged rates lower in an environment that has been grinding investors down for months. Here is exactly what happened and what you should do about it right now. Stay until the end. I am going to show you exactly how keeping your liquidity reserves strong can lower your DSCR loan rate and potentially save you thousands, even in this still elevated rate environment.
The ceasefire nobody expected. How oil crashed and rates followed.
On August 7th, the US and Iran agreed to a 2-week ceasefire, reopening the Strait of Hormuz and pausing US airstrike on Iranian infrastructure. The market reaction was immediate and dramatic. Brent crude plunged roughly 13% and WTI dropped nearly 15% from recent peaks, rolling back a major chunk of the war premium that had been backed into energy prices for weeks. When oil drops that fast, inflation fear drops with it, and bond investors rushed into treasuries as a relief trade. The 10-year treasury yield fell about 9 to 10 basis points into the low 4.2s. The 30-year followed, and mortgage rate drifted lower right alongside them. This is exactly how geopolitics transmits into your financing costs. Not through the Fed, not through a jobs report, through a single diplomatic announcement that reversed one of the biggest inflationary pressures of early 2026. The ceasefire is only 2 weeks long, which means this window could slam shut fast, but for now it meaningfully reduced the tail risk of another energy shock spike in mortgage and DSCR loan rates.
The CPI paradox, hot headline, cool core, and what it actually means.
March CPI dropped on March 10th, and the headline numbers looked alarming. Prices are up 0.9% month over month and 3.3% year over year. But dig one layer deeper and the picture changes entirely. Nearly 3/4 of that monthly increase came from a single category: energy. Gasoline alone surged 21.2% in March, driven of course by the same Iran war. Premium, the ceasefire just deflated. Core CPI, which strips out food and energy, came in at just 0.2% month over month, matching forecasts and showing no new broad-based price pressures. Medical care, personal care, and used vehicles actually declined. Markets read this correctly. The headline is backward-looking oil shock, not a new inflationary spiral. That gave bond investors cover to accept lower yields, even on CPI release day, which almost never happens when the headlines number is this hot. The practical takeaway for anyone pricing a deal right now is that the inflation story is more nuanced than the numbers suggest. And with the Iran ceasefire taking oil back down, the March spike may not repeat in April's data.
The rate update. The major economic indicators and how they're affecting your wallet.
30-year fixed mortgage rate started at 6.45%, ended at 6.38%. DSCR loans rates ran approximately 0.75 above conventional this week, putting most investors in the range of 7.13 to 7.38%, depending of course on leverage, credit score, and property type. A modest improvement from where we were sitting in late March. Initial jobless claims rose to 219,000 for the week ending April 4th, up 16,000 from 203,000 the prior week, and slightly above the consensus of 210,000. This print came in along the ADP report, showing only 62,000 private sector jobs added in March, a notable step down from earlier months. Neither number signals a labor market in trouble, but together they paint a picture of gradual cooling that nudged bond yields a bit lower and supported the week's modest rate improvement. Tenants are still broadly employed and paying rent, while the softening trend gently tilts the macro backdrop in a more rate-friendly direction over time.
Your move: lock the stability or wait for the ceasefire to expire.
Here is the honest read on this week. The improvement in rate is real but fragile. The 2-week ceasefire is the single biggest variable in play. If it holds and leads to something more durable, oil stays lower, inflation cools further, and there is a credible path towards DSCR loan rates drifting into the mid to low 7s over the coming months. If it collapses, and 2 weeks is not a long runway, oil spikes back, Treasury yields reverse, and we are retesting late March highs before you can blink. That means the current window, while small, is real. If you have a deal under contract and you are within 30 to 45 days of closing, the case for locking now is strong. Floating into a ceasefire expiration is a gamble, not a strategy. If you're still in acquisition mode, this week's data gives you a more stable foundation for running your numbers. Use it. Now let me unpack the strategy I promise you. Show strong liquidity reserves in DSCR lending. Reserves are not just a safety net, they are a direct pricing lever. Lenders view borrowers with substantial post-closing liquidity as lower risk, and that reduced risk translates into better rate pricing. The more months of mortgage payments you can show in reserves after closing, the better your rate tier in a market where DSCR loans rates are still sitting in the mid to high 7s for most investors. Crossing a reserve threshold, say moving from 6 months to 12 months of reserves, can be the difference between 7.25% rate and a 7% rate on your next rental property. That quarter point savings compounds into real money over the life of the loan. If you want to explore other strategies that work better for your specific situation, call or text me directly. Our info is in the description below, and I will walk you through exactly how to position your next deal for the best possible pricing.
If you want to learn how to use financing to grow your portfolio, check out my DSCR loan tips and tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.